Ray Dalio, a global macro investor, emphasizes the importance of economics, financial markets, politics, and geopolitics in his investment approach. He also notes 3 unprecedented developments in his lifetime, and it's important that you know about them too. These are the 3 unprecedented developments in Dalio's lifetime. The substantial accumulation of debt and creation of extensive amounts of money, escalating internal conflicts concerning monetary matters and values, and the shifting world order marked by heightened competition among nations like China and Russia challenging the United States, a phenomenon we have never seen before. It's widely acknowledged that increasing money supply and spending is essential, but when spendings exceed earnings, borrowing becomes necessary, resulting in debt. Initially, borrowing provides purchasing power, but repayment obligations is just depressing. To avoid this, central banks resort to printing money to buy back debt, but this devalues currency. Now, an influx of money and credit into the market elevates purchasing power, leading us to feel optimistic. However, the subsequent rise in prices shouldn't come as a surprise, as the relationship between money and credit in circulation and the quantity of goods produced dictates changes in prices. This phenomenon, occurring in a significant wave, is the current economic reality. This surge in spending has resulted in a significant inflation rate ranging from approximately 7.5% on a year-over-year basis to closer to 12% when considering core inflation. While temporary factors may play a role, the primary driver is the excessive level of spending. The inflationary trend is escalating, with spending levels being the key measure rather than temporary supply bottlenecks. What seems to matter is purchasing power, which disappears when inflation outpaces other sources of income. Interestingly, this loss of buying power can sometimes be more tolerable to people when it happens through inflation, compared to direct deductions from their pockets, such as tax increases. When money is printed and distributed to everyone, it may seem more acceptable, despite the erosion of buying power affecting those holding assets like money market and bond funds. For instance, bond funds may experience a decline of around 10%, while inflation rises by approximately 8%, resulting in an overall loss of 18% in buying power for investors. Inflation is often perceived as merely resulting in higher prices, which may seem like a concern primarily for the rich people who can afford to pay more. However, this perspective overlooks the fact that higher inflation doesn't equate to obtaining more goods or services. Instead, it redistributes purchasing power away from certain people, disadvantaging those who can't afford the increased prices. Currently, we're entering a phase where inflation erodes buying power, while the Federal Reserve seeks to counter it by tightening monetary policy, reducing the availability of money and credit, raising interest rates, and limiting spending. This dual approach aims to curb inflation, but results in a squeeze effect like the challenges faced during the 1970s. These paradigm shifts often unfold gradually as people's mindsets and behaviors adapt over time. Initially, many investors think of cash as a safe asset and may not be overly concerned about inflation. However, as inflation becomes more obvious and starts to erode the purchasing power of cash holdings, investors reassess their strategies. They may sell cash or bonds and reallocate their investments into other assets. This shift in investment behavior can further contribute to inflationary pressures. Similarly, changes happen in various aspects of life, such as adjustments in compensation to account for rising living costs. In the past, when inflation wasn't a primary concern, people might not have considered inflation-linked contracts or investing in assets that protect against inflation. However, as inflation becomes more prominent, people rethink their financial strategies and start seeking out inflation-resistant assets or adjust their spending habits, such as investing in real estate. These shifts in mindset and behavior are self-reinforcing in the early stages, contributing to further inflation and shaping psychological attitudes toward inflation. Eventually, this process may lead to an extreme reversal in sentiment and behavior. In the 1970s, people were caught off guard by the onset of inflation, as it was a relatively new concept for many. Initially, there was a swing in sentiment, with concerns growing about the seemingly endless nature of inflation. This led to widespread positioning for a perpetual inflationary environment. However, as inflation escalated to alarming levels, central banks reacted by adopting policies at the opposite extreme to combat it. This shift marked the beginning of the 1980s, characterized by a stark reversal from the inflationary trends of the previous decade. During the 1980s, the economic landscape transformed, with inflation giving way to falling prices and high real interest rates. As a result, the assets that performed poorly in the 1970s, such as bonds, became favorable investments in the 1980s. This illustrates the cyclical nature of market dynamics, where sentiment and investment preferences swing from one extreme to another in response to changing economic conditions. When Ray Dalio delved into these matters, he uncovered not only the three forces previously mentioned, but also identified a fourth and fifth force. Notably, natural occurrences like droughts, floods, and pandemics have historically exerted a considerable impact, surpassing the effects of other factors in terms of economic cost, loss of life, or societal upheaval. Furthermore, Dalio highlights the fifth force, mankind's remarkable ability to adapt and innovate over extended periods, spanning decades. Despite events like the Great Depression or wars, which may seem significant in the moment, they appear as minor blips when viewed within the broader context of long-term trends such as life expectancy and per capita income. This resilience stems from humanity's capacity to adapt and innovate effectively. Dalio also emphasizes the pivotal role of technology, particularly artificial intelligence and data analytics, in enhancing human capabilities. While these advancements offer tremendous potential for progress, they also entail risks because they can be used for good or bad purposes. The world will continue to go through cycles of change and development, with expectations of encountering fluctuations, progress, and adaptation along the way. However, there will always be uncertainties and potential concerns stemming from the unpredictable nature of various factors. It feels like we're in a bit of a who knows stage right now, where new things are popping up and crying for attention. People are starting to think about how to put together a mix of popular options that they can switch between easily. Lastly, Dalio believes money isn't valuable in itself. It's more about what it lets you do, like having freedom, being creative, and helping others. For him, success means having enough money to live comfortably and do what you want. He's noticed that lots of people, no matter their age or money, find joy in exploring different cultures, even if they're not rolling in cash. He warns against getting too caught up in status or seeking approval from others. Instead, he thinks it's important to focus on what makes you happy and fulfilled. According to him, a truly satisfying life comes from doing work you love and having meaningful relationships, not just from having lots of money or being popular. Well, that's about it for today's video. If you liked today's content, be sure to hit the like and subscribe button. Thank you so much for watching, and we'll see you in the next one.